We start off with a rally that almost was. The earnings euphoria fading today as big moves from IBM, United Technologies, and P&G fueling an early morning rally. The Dow jumping nearly 300 points before shedding those gains. So there is one key leading indicator that we want to pay attention to. Netflix, the stock falling again today, now down nearly 10% since its earnings report last week. This is a trend, remember, that we saw back in October. Netflix fell 17% in the month after its earnings report. Then the market followed suit in the months afterwards. So are we seeing the same move again? Is Netflix the canary in the coal mine, Guy?
Well, I think it might be. And Steve's pointed this out since the fall. If you go back, as you mentioned, that report in October, the stock initially went higher, reverse went lower. Within a couple weeks, the S&P followed. I think that's what's going to happen now. Listen, the Dow was up 170, 200 points today. I get it. The S&P was only up 5.5, 6. You mentioned the reasons why. I still think, look, if not a retest to the downside, it's going to get pretty close. I think Netflix gets us there. I think Netflix trades 300 before it trades 350.
Yeah, this is definitely something I've been watching since the fall. But you got to remember, Netflix was up from that low 50%. That was a hell of an overbought situation that you had with Netflix. It deserves to come off. I do think it will be indicative of a sell-off for the overall.
How much was it up from January 1st to the highs before earnings, though? I mean, was on a torrid run.
Oh, yes.
Some would argue that it's the same sort of pattern, although this time it's on a compressed time frame.
And I think it looks a heck of a lot like the market, to your point, though, Steve, and you've been pointing this out. I think it's been great because this market, January, has been absolutely exploding to the upside, especially in the last week and a half, let's call it. And then suddenly, as you look at Netflix, what a run. I mean, I know it because I actually own some Netflix. I was looking for a pullback, Mel, because I've been trying to do this buy right strategy against it for a while now where I can buy it back and roll it up. I actually just executed that again yesterday. So I'm okay with it. I was actually hoping it would get back to these levels. I don't know that it necessarily has to bring down. I don't know whether the S&P has to test lows or if Netflix has to go back down and test lows, because I think when we look at the numbers as we're getting through earnings season, particularly today, we had IBM, we had United Technology, we had Procter & Gamble. That really did put the Dow up in a great spot. But Facebook and some of the NASDAQ stocks started to sink a little bit as the day started to go off.
Well, so we're having this discussion because ultimately Netflix is one of those names that is a high multiple stock that's all about growth. And if you look at it, today's earnings, the reason IBM, the reason UTX, these stocks are outperforming is there's specific things around these companies that are reasons why people are rallying UTX. And we don't need to get into that, but that's all about UTX dynamics, IBM, all about IBM dynamics. Look at the financials. The reason the financials rallied as much as they did was because, frankly, they were mispriced. Netflix is, if anything, they were mispriced to the downside. If anything, in my view, and this has been my view, Netflix is mispriced to the upside. We're in a market right now that is challenging growth. So, yes, it's right that we're looking at it. And ultimately, I think Netflix had numbers that when any other quarter other than the last quarter, when also we were in a challenging environment, were more than enough to send that stock higher.
I think it's an odd time because the market is so volatile that we're trading off of a lot more off of technicals. And when you look at Netflix, the stock, it overshot just a bit. That number should have been 350. That was the high end of the sell zone for Netflix specifically. Overshot by $8. The market did the same thing on a percentage basis. So I think they're both coming in.
Is this a warning sign, though, for the rest of technology? I mean, if this is, as you had mentioned, it was a good earnings report. Any other quarter, the stock would have been fine, except for a quarter in which the stock ran up 50% going into it. We see this time and time again with a lot of the other names off the December 24th lows, right? Big rally going into earnings. Does this mean that it's got to just knock the cover off the ball in terms of the report?
I think they absolutely have to, and I think we're seeing some of that this evening. We'll talk about some of the earnings today, even, and not necessarily technology, but in the chip space. But it's pretty interesting, Mel, because when you look at some of these numbers and some of these names, which names have overshot to the upside? I think that's really what the game's all about in terms of trying to figure out where the markets are going, because Apple, has that overshot to the upside? I don't think so, off of its lows, but there are names that absolutely have. Netflix would be one of those that absolutely exploded to the upside, and it almost inexplicably, the way it moved so fast, Steve, we were under 300, what were we, 260? We went all the way up to 350? I mean, that's a pretty extraordinary move in a very short period of time.
Look at the names that are responsible for the market just ticking up. And Netflix has been one of those horsemen.
Yes.
So it's going to be, everyone, the word I use is always torque. It's always torque. It's higher
uses that
beta.
word.
I always use it, right?
torque.
And you always say the same
Torque
thing.
this, torque that.
all the time.
All the time.
And I will tell you that if the market's going to come in, it's going to be based on these 4 to 6 to 7 names that do the heavy lifting. So it all stands to reason that you see a Netflix shoot up and come in higher and worse than the overall market.
But aren't we also, couldn't we have a conversation about stocks that are underperforming in this environment as well, and that those are the wounded animals? In other words, Apple is an argument there. FedEx is an argument there. These are companies that did not participate in this upside move. And what is more emblematic of the environment we're in? It's fallen angel companies, and I don't mean it in the credit context, but I mean, those that were the most popular and the most loved companies that no longer are trading like they did.
So you mean like a Netflix or like an Apple?
Well, I think for now, Netflix is a high multiple stock that's going to be under more pressure in an environment like this. But I think in an environment where people are challenging growth and you've seen companies have had their basic thesis challenged, those are the companies that, to me, are more representative of where we are right now.
It's interesting. UTEX, the fourth quarter was ridiculously. I don't know where they pulled this quarter out of. I mean, the EPS beat was pretty substantial.
Yeah.
But the full year guidance, you know what? You look at their full year guidance for 19, it wasn't great. I think they guided $7.70 to $8, pretty much in line with previous guidance. So they could have guided high. I guess they could have guided higher. They didn't. Stock was up 5.5%. Why? Because it's been sold off so much. Yes, it's bounced off the December 24th low. You can make a case on valuation, but I don't think this was a 5.5% to the upside quarter. The same way, by the way, I didn't think Stanley Works was a down 15% quarter yesterday. So things are getting a little out of control. I think IBM is specific to IBM. I didn't think that was a ridiculously great quarter. I think people are buying into the fact that maybe Red Hat can be their saving grace. I'm not sure.
I think that's what you just put your and Rockwell Collins in terms of United Technologies. I think people are rewarding because of what they see going forward and getting better visibility potentially going forward because of the acquisitions, very bold acquisitions, especially Red Hat. That's the biggest ever in IBM, right? At $34 billion.
Yeah.
I mean, that's a monster.
And UTX, as Pete talks about, this whole Collins deal, and basically it's a spin out of 3 companies now. You're going to create 3 industry-leading businesses, and the timing of that spin-out's actually been moved up. It's 18 months instead of 2 years. That's very positive for the stock with free cash flow. Stock-specific good news there.